Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're delving into the latest mortgage industry buzz, specifically the ongoing rate war that's heating up as bank renewals are poised to surge. According to a recent analysis by RBC, more than half of all mortgages held by Canadian banks are coming up for renewal over the next 2 years. This scenario has ignited fierce competition among lenders, as interest rates have fallen from their peak levels. It's an opportune moment for mortgage shoppers, particularly those whose loans were secured at historically low rates, to seek better deals. RBC analyst Darko Mihelic notes that in today's market, even a small reduction in mortgage rates can lead to significant savings. For instance, a 50 basis point decrease in the renewal rate could save a homeowner around $1,000 annually. This potential for savings is expected to drive mortgage brokers to proactively reach out to their clients, offering more attractive renewal terms. Interestingly, TD Bank, which is facing some challenges with its expansion in the United States, might refocus its efforts on Canadian mortgage renewals to meet its financial goals. This shift could compel other major banks to enhance their competitive strategies. Mihelic highlights that all Canadian banks consider mortgages a crucial product, especially since loan growth in other areas is currently quite low. The opportunity to capture market share from competitors is substantial. However, this competitive environment poses challenges for smaller brokers. Many have expressed concerns about competing with the aggressive pricing strategies of the big banks. John Webster, former CEO of Scotia Mortgage Authority, remarked on some silly business among the banks as they strive to meet quarterly revenue targets. Although he acknowledges the current pricing competition, he believes it might not be solely driven by market share and anticipates a return to more rational pricing in the near future. These dynamics reflect a broader confluence of circumstances, including the struggles of TD and CIBC in gaining market share, which have spurred the big banks to become more competitive. Yet there's an expectation that this intense competition won't last indefinitely, with hopes for a more sustainable and rational pricing environment as we move into the first quarter of the coming year. Canada's rising insolvency rates are painting a concerning picture for both individuals and businesses across the nation. In the third quarter of 2024, approximately 34,588 Canadians filed for consumer insolvency. This figure marks a 13.5% increase from the same period last year, as reported by the Office of the Superintendent of Bankruptcy. Interestingly, year-over-year consumer insolvencies have been on the rise in double digits for 10 consecutive quarters, beginning in the second quarter of 2022. Andre Bolduc, the chair of the Canadian Association of Insolvency and Restructuring Professionals, highlights that Canadians are grappling with increasing debt loads alongside a persistently high cost of living. Although inflation has slowed, essential items like groceries continue to be costly, putting additional strain on household budgets. This situation is particularly worrisome for homeowners with mortgages up for renewal in 2025, as they may face higher interest rates that could significantly increase monthly payments. Those already burdened with debt could find themselves even more vulnerable to insolvency. Bolduc mentions that while there's been some short-term stabilization of consumer insolvencies, partly due to this year's interest rate cuts and a slowing inflation rate, a long-term financial strategy remains critical for those at risk. In the 12 months leading up to September 2024, consumer insolvencies surged to 135,368, marking a 15.4% increase from the previous year. On average, 376 Canadians filed for consumer insolvency each day during the third quarter of 2024. The situation in Ontario is particularly acute, with insolvencies rising by 20.2%. Similar increases have been recorded in Alberta and Quebec, where the rates rose by 13.8% and 12.2% respectively. Business insolvencies have also escalated, with 1,312 filings in the third quarter of 2024, the highest for a third quarter since 2009. Despite a 14.9% decrease from the previous quarter, these numbers remain 58.6% above pre-pandemic levels from 2019. Bolduc explains that after years of economic turbulence, some business owners are experiencing what he describes as director fatigue. The constant pressure to adapt to shifting conditions is both challenging and exhausting, leading some to consider closing their doors as the only viable option amid ongoing uncertainty. Sectors such as construction, accommodation, food services, transportation, and warehousing have seen the largest year-over-year increases in insolvencies. Small businesses continue to face sustained pressures from high operating costs. While government relief measures, like the $2.5 billion in carbon tax rebates and reduced credit card processing fees, have offered some help, they are still under significant strain. Bolduc notes that these measures might not resolve all financial pressures, but can alleviate some of the cash flow challenges that have been burdening small businesses. The Greater Toronto Area's real estate market has experienced a remarkable uptick in home sales, with figures showing a nearly 50% increase compared to the previous year. As we approach the end of 2024, the real estate landscape in the GTA seems to have reached a point of stabilization, with a significant rise in transactions. This encouraging trend is highlighted in a recent report by the Toronto Regional Real Estate Board, TRREB, which shows that October's home sales numbers have surged substantially compared to the same month in 2023. Two primary factors have driven this shift in the market dynamics. Firstly, market conditions have tightened compared to 2023, creating a more competitive environment for buyers and sellers alike. Secondly, there has been a slight increase in the average selling price of homes in key cities, including Toronto, Mississauga, Brampton, and Hamilton. These factors combined have contributed to the impressive sales growth. Jennifer Pierce, the president of TRREB, expressed optimism about the current market situation. She noted that more buyers have decided to re-enter the marketplace, encouraged by the favorable affordability brought on by lower borrowing costs and stable home prices. This shift has led to a considerable improvement in market activity, as potential homeowners find the conditions more conducive to making a purchase. When we delve deeper into the numbers, TRREB's internal data, alongside insights from the GTA Realtors Group, reveals a staggering 44% increase in sales across the GTA. This surge in activity is a promising sign for the real estate sector, indicating a resurgence of confidence among buyers, which could be attributed to the overall economic climate and the current interest rate environment. In response to these positive developments, organizations like TRREB are advocating for political actions to further enhance market conditions. One such recommendation is to improve affordability by reducing taxes on homebuyers. TRREB has expressed support for the Conservative Party of Canada's proposal to eliminate the goods and services tax on new homes priced under $1 million. This policy is seen as a crucial step towards providing much-needed relief to new homebuyers, making homeownership more accessible. Ontario's housing market is facing a critical juncture, with new housing starts predicted to decline in the coming years, according to a report by the Residential Construction Council of Ontario, or RESCON. The report highlights a combination of rising costs and bureaucratic hurdles that are discouraging developers from pursuing new projects, thereby exacerbating the already existing housing shortage across the province. In the Greater Toronto Area, for example, municipal fees for single-family homes have risen sharply, averaging $164,920, which is an increase of $42,000 from last year. Similarly, apartment fees have jumped to an average of $122,387, marking a $32,000 rise. These fees are just part of the financial burden developers face, as approval delays can add costs of between $2,672 and $5,576 per month, depending on the municipality. This can inflate the cost per unit by up to $90,000. Richard Lyle, president of RESCON, expressed concern over these rising costs, emphasizing the strain they place on builders. He warned that a slowdown in construction could lead to significant job losses not only within the housing sector, but also in related industries, posing broader economic risks. The findings of this report are particularly worrisome for builders, as they point to a weakening residential construction market at the very time we need to build more housing, Lyell stated. The report calls for governmental intervention to mitigate these challenges. It suggests reducing taxes, fees, and other regulatory costs that impact builders, along with streamlining approval processes to eliminate bureaucratic barriers. Lyell emphasized the urgency of government action, stating, "With a critical need for new housing, it is imperative that all levels of government take immediate action to boost construction by lowering the taxes, fees, and levies, and reducing the red tape and bureaucracy which slows the industry and adds to the cost of housing." Looking ahead, the report outlines a concerning forecast with two potential scenarios. Both scenarios predict a continued decline in housing starts and employment through 2025, with only a gradual recovery expected between 2026 and 2028. This means that home availability will likely remain tight, keeping prices high. Lyell urged governments to unite in addressing these issues, noting that while some progress has been made, such as the federal conservatives' proposal to remove sales taxes on new homes under $1 million, more needs to be done. He concluded by stressing the importance of reducing bureaucratic hurdles to facilitate new home construction. If we don't take these steps, the consequences could be catastrophic for our industry and the economy, Lyell warned. It's clear that without decisive action, Ontario's housing market could face significant challenges in the years to come. In a significant development on the international stage, Tiff Macklem, the Governor of the Bank of Canada, has been appointed to chair the Consultative Council for the Americas, or CCA, under the Bank for International Settlements, known as BIS. Starting January 1st, 2025, Macklem will take on this two-year term, succeeding Brazil's central bank governor, Roberto Campos Neto. This appointment marks a notable Canadian leadership role within the BIS, an institution that oversees monetary stability and coordination among central banks globally. The CCA, established in 2008, includes central bank governors from across the Americas, including the United States, Argentina, Brazil, Chile, Colombia, Mexico, and Peru. This group provides critical regional guidance on strategic issues in global finance. Operating from the BIS Americas office in Mexico City, its members collaborate on key monetary policy issues and financial innovations. Macklem's new role is expected to involve advising the BIS on challenges and priorities for the Americas region, supporting initiatives in areas like economic productivity, monetary policy, and advancements in digital payments. Additionally, the BIS has announced that François Villeroy de Galhau, the governor of the Bank of France, has been re-elected as chair of its board for another three-year term, effective January 12, 2025. Meanwhile, in a separate leadership change, Pablo Hernández de Cos, the former governor of the Bank of Spain, has been named the next general manager of the BIS, beginning his term on July 1, 2025. These appointments highlight the ongoing shifts in leadership within the BIS, reinforcing its global influence in monetary policy. Back in Canada, the banking landscape might see heightened competition as the central bank's recent interest rate cuts start to impact the mortgage market. With over half of Canadian mortgages set to renew in the next 2 years, RBC analysts have warned of a potential mortgage war among major banks, each vying to offer the best rates to borrowers eager to ease their monthly payments. This increased competition is likely as banks recognize the critical role mortgages play as a significant anchor product in their portfolios. According to RBC's Darko Mihelic, even a modest 50 basis point drop in renewal rates could mean savings of around $1,000 per year for borrowers who secured their mortgages during the ultra-low rate environment of 2020. With loan growth across multiple categories currently low, the opportunity to capture market share from competitors is significant. This anticipated mortgage competition may also be influenced by TD Bank's current situation. Following a recent $3.1 billion fine from the United States Department of Justice and restrictions on its United States retail banking growth due to regulatory compliance issues, TD may seek to strengthen its market position domestically, thereby heightening competition further. This scenario could pressure banks like the Bank of Montreal, Scotiabank, and the Canadian Imperial Bank of Commerce, all of which have significant mortgage portfolios. In essence, Mihalik suggests that the Bank of Montreal, the Bank of Nova Scotia, and the Canadian Imperial Bank of Commerce are most at risk of mortgage spread compression or loss of customers. These dynamics could lead to narrower profit margins and a focus on locking borrowers into long-term deals. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.